There's a number that's been hammered into the American home buying conversation for decades, and it's costing people more money than almost any other piece of financial advice. That number is 20%. I want to walk you through what you actually need for a down payment on a house, where the 20% number came from, and why waiting to save is usually costing you more than just buying sooner with a lower down payment. Let's cover the actual minimums first. Conventional loans start at just 3% down for first-time home buyers and 5% for everyone else. FHA loans require a 3.5% down payment with a 580 or higher credit score. VA loans for veterans who are eligible have no down payment requirement. And USDA loans for eligible rural and suburban properties are also zero down. So the real minimum across mainstream loan products is somewhere between 0 and 5%, depending on which one fits your situation. 20% is not a minimum anywhere in mainstream lending for primary residences. Where the 20% number came from is actually pretty simple. If you put 20% down on a conventional loan, you avoid private mortgage insurance called PMI. That's the only mortgage-specific reason that 20% matters. It's a threshold that gets you out of paying PMI, not a requirement to buy a home. And the cost of putting less than 20% down is the PMI itself, which is added on to your monthly payment. And on a conventional loan of $400,000, that can range anywhere from $30 up to $400 or $500 a month, depending on several factors. PMI drops off automatically when you reach 22% of equity on a conventional loan. So it's a temporary cost. It's not a permanent one. And the cost of waiting until you have a 20% down payment saved is harder to see because you're not paying it monthly, but it's usually a bigger cost. For example, if a buyer needs $80,000 for 20% down on a $400,000 home, then let's say they're saving $1,500 a month. That's over 4 years of savings. And in 4 years, two things happen. Number one, the home you wanted is no longer $400,000 because home prices have historically risen faster than wages. And you've paid roughly $90,000 in rent during that time that you were saving up for the down payment, which is money that's gone permanently and will build no equity. Meanwhile, the buyer, that version of you who put 5% down with PMI and bought immediately, may have paid $10,000 in PMI over the same period, but they captured 4 years of appreciation and built 4 years of equity. The math almost always favors buying sooner with less down, especially in markets with consistent appreciation, as long as you actually stay in the house. Now, there are situations where 20% down actually makes sense. If you have the cash and you specifically want the lowest possible monthly payment, if you're buying an investment property where the down payment requirements are higher, like 20 or 25%, or if you're in a market that's flat or declining, where the appreciation argument doesn't apply so much, and really you need extra security in case of further price declines, then 20% makes a lot more sense. But for most first-time home buyers, the 20% goal is a barrier. It's not a target. The right down payment is the one that lets you buy a home you can comfortably afford on a timeline that works for your life and with a loan program that fits your situation. If you want to run the numbers on what that actually looks like and what's possible for your situation, schedule a discovery call and I'll walk you through it.